did so well in the first panel that they called me back for the second one. Mr. Robinson. No, it's Robson, actually. Cool. Yeah, do you know how much money is on this stage? Can you imagine? Really? Great job for the organizers for bringing these people. So yeah, let's start from the beginning. This year was incredible. We just lost so much. Companies dying, but also just VC funding drying out. And yeah, usually the capital markets, trickle down to US VCs, who trickle down to LATAM, and then Asia, and then Africa. And when this period of downturn happens, the first markets to dry out of VC money is actually Middle East, Africa, where unfortunately the last in that process of trickling down. So first question is what happens when the foreign VCs go back on risk off, and then there's local AUM who's not enough to sustain our local winners?
Sure, so happy to kick us off. I'm Courtney Powell with 500 Global. And first of all, just want to say how great it is to be here. So happy to see that there is a conference like Forbes 30 Under 30 here in the region, because at least from 500's perspective, we believe that the Middle East is one of the most exciting markets for entrepreneurship globally. So really looking forward to this chat. I think, certainly we have an interesting purview because we're based in Silicon Valley, but we have 30 funds that are investing in more than 80 countries around the world. So today we're managing about $3 billion in several funds here in the region. So when the downturns happen, we certainly do see that the tourist capital, flights. However, we're still continuing to see a lot of capital being deployed here in the region. From seed stage, especially, I think has continued to be fairly strong. And even in the earlier stage, I do think in the later stage, once we start seeing kind of Series B and beyond, things are going to get a little bit tougher. But I still think there's a lot of momentum and a lot of opportunity for founders who are building great businesses, and they will continue to be funded.
Hey everybody, pleasure to be here. This is nearly my 24-hour anniversary in Egypt, and it's been a great experience so far. Yeah, right. Absolutely. I'm George, I'm a partner of Sequoia. Our business, all our businesses I think are different, but we have a global footprint and we invest from pre-seed to pre-IPO. We've been doing that now for 51 years in early stage companies. I think the output of that is, there are people on our team that have been through multiple crises over that time frame. And we think about our responsibility in that as really to continue to deploy capital at a consistent rate across stages, across geographies. And we actually manage that very carefully and deliberately inside of our team. I think remembering that all of our job, us as investors, many of you as builders, is to project into the future, and remembering that creating profound change takes an incredibly long time and requires inputs from the ecosystem, from regulators, from talent, from universities, many different stakeholders. I think what is clear is that the momentum that has been gained over the last 5+ years in the region will not slow down. Yes, it might mean that there are tougher questions to be asked of companies maybe earlier in their journey, but it's the same goal at the end of the day, which is to create a meaningful relationship with your end customer that allows you to dominate an important market over a 15 to 20 year time horizon, which definitely supersedes anything you see in the current economic cycle. So it's not necessarily easy, but we're trying to be measured, controlled at Sequoia. I'm sure you're all doing the same thing in your businesses, so there's much to be optimistic about.
Thank you. Firstly, pleasure to be here, and thanks to Forbes Middle East and all the organizers involved in making such a nice event happen, and great to be here with the distinguished panel members. I'll just start off by saying that the macro backdrop has been bleak, to say the least. We're seeing a once-in-a-generation surge in prices. I think inflation is at a 40+ year high, globally on average. The US Fed is raising interest rates at the highest rate since the 1980s. The dollar is strongest it's been in decades, which kind of sucks for us in emerging markets. Add to that geopolitical issues, globalization being in retreat. It all sounds very depressing. But against that backdrop, and linked to that also, actually I should add that public equity markets have corrected. S&P 500 I think is down maybe 20% year to date. the tech-heavy Nasdaq 30% or so. So kind of the impact for technology companies has been more acute. But having said that, I think the startup ecosystem it's not all doom and gloom. I think there is still very much a need for innovation. Your total addressable market, the problems you're solving, the pain points, the opportunity, it's still the same. It's just the fundraising environment that's changed. And unfortunately, it's changed pretty quickly. Going back to the start of this year, the rules of the game have changed. Founders were encouraged to grow and were being rewarded to grow almost at any cost. That has now changed. People are starting to come back to first principles. Can you sell a product for more than it's costing you to make and sell? Is there a clear path for you to become cash flow positive? And are you focusing on the right things you need to be focusing on? Especially if you're early stage, that probably involves making some objective trade-offs from a learning agenda perspective. But again, I want to come back to say it's not all doom and gloom. I think if you can describe a business that is generating cash, growing healthy, and has positive unit economics, you can probably raise money in any environment. And I have a couple of actually encouraging examples. Like, what does companies like WhatsApp, Instagram, Airbnb, Square, now Block, Slack, Pinterest, one of the things they have in common at least is that they were all created in the aftermath of the global financial crisis. So I think now is a time for very healthy and interesting companies to be built. Do not be discouraged by the depressing macro and fundraising backdrop.
I think everybody said everything, so there's not much for me to add, but I'm just going to say that in 2019, we were making investments with a certain amount of, you can see the range in investment valuations and how that hiked up between 2 to 3 times during the next year. That's something, and I think that we're actually seeing a market correction. It's good for VCs from one angle. Of course, there is the economic performance, which is the other side, but I share with everybody here that we are in a region where there's a lot of room for fixing market inefficiencies, scaling up everything that has to do with growth and optimization. I think we have a lot of room to grow from that perspective. Yes, there is going to be some losers and some tough times, but I think if we talk about Egypt, I think we have a long way to go before we consider that we have reached to the point where we have to think about cutting down investments. I do encourage every VC here to actually, especially the ones that actually have raised funds for this region, to actually deploy, not take a pause, not slow down, because you're going to hurt the ecosystem without realizing it, actually realizing it. And all the fundamentals, yes, there are actually a lot of warning signs, but there's also a lot of growing signs. So you have to think of one as an investor, not as a banker. You need to be thinking how you make investments, not how to consider attractive investments. That comes at a later stage, as like Courtney was saying, the C and D and onwards, but there's a lot of room to push for the earlier stages and also make the right bets with the winning partners anyway. As for Egypt Ventures, we actually talked to our government, they're our backers, they're our LPs, and they said, we had 2 recent exits this year, and they said, we don't want the money back. We actually want you to reinvest it. So we said, that's good news for the ecosystem. We are investing, we're not stopping, we're investing as usual, and we'll continue to do the same process. We took the money for the same reason, to invest in the ecosystem. We're betting on it, we're not putting down.
Yeah, and if I could just add quickly to that, I think this is also one of the unique advantages in the Middle East. You have governments who are leaning in very heavily to support entrepreneurship. And I think we'll make a formal announcement later today, but even 500, we recently signed a partnership with the Tatita to begin deploying into pre-Series A companies in Egypt with dedicated programs and funds on the ground in Egypt. So there are a variety of governments in the region who are trying to make sure that the gains that this ecosystem has had over the last 5 to 7 years, call it, continue. And that's not necessarily the case everywhere in the world. So I think this is a really big bright spot and why founders should keep starting companies and keep seeking out VC money in the region.
And reflecting back on what happened this year and the couple of previous years, it was so predictable in hindsight. It's always, you can only connect the dots in hindsight, but also avoidable. And when I try to think of, is it the founder's fault? Is it the investor's fault? It always comes back to the investors. I think nobody forced investors to write uncapped notes or 20x revenue multiples and stuff. Nobody forced them. And these cycles and downturns keeps happening because we have a short memory and we fall into the same traps over and over and over again. So I want to have this quick discussion on, what are the lessons learned of, for lack of discipline and everything else over the past couple of years, and how do you make sure that we don't fall into the same trap in 8 years, 12 years, 15 years?
Happy to kick that off. 2020 or 2021 and the prior years to that, I think there was a lot of excess. Capital was abundant. Governance and diligence went out the window. There's, without mentioning names, but there's stories that are pretty well covered, I think, about how you had some investors that were doing more than one deal every business day in 2021. Founders being offered more money than they needed and say, grow, just max out on the gas. No kind of strong controls and governance and checks and balances on boards. I think that, to summarize, that is in my view what I mean when I say excess of kind of the period up to 2021. Vision is 6 over 6 in the rearview mirror, obviously. So now I think we can look back and say these were the issues. I hope that as an ecosystem we learn from these issues. It'll be good to come back to a world where valuations are, to some degree at least, based on fundamentals. Healthy businesses and sustainable businesses are being built. I'm very happy to see that the grow at any cost mantra is now kind of phased out almost completely. I think that's positive, and healthy companies, I think, will be built in this environment. Looking at whether it's a founder's fault, an investor's fault, I don't think that matters. I think as a whole, as an ecosystem, everyone involved is responsible in setting standards that make the ecosystem healthy for all participants and stakeholders. So given the learnings we've seen over the last few years, I think as we build our ecosystem, which in MENA is still relatively nascent, we need to bear these learnings in mind and remember them as we go forward and make sure that we kind of make them the most out of these learnings.
Any lessons learned?
Yeah, I maybe share a couple of points. I mean, we believe that in the long run, laws of gravity apply to all companies. And we always tell our founders the only way to be truly free is to generate free cash flow, right, in the long run. And maybe the strength of that message slightly earlier in the company's journey has got louder over the course of the last 18 months. But having consideration for the fact that sort of the flip side of that is, obviously in an environment of scarcity, and you're saying around excess, scarcity around capital, but also thinking about the size of the team you need given the stage of the business, the path dependency that you create when you commit to maybe overhiring, trying to be more aggressive on acquisition and expansion across geographies, across different channels. I just see we're seeing that level of conviction you need before you create that path dependency increasing in the current market. And generally, we think that's wonderful because actually talent is pretty inelastic in the short term. And what we've seen over the last 2 years is a risk-reward perception for early-stage founders going out to build a company has changed. And the flip side of that is if talent is inelastic, it doesn't necessarily mean you will have many more businesses that generate meaningful long-term value, but it does mean that across these ecosystems, you have many more people that have a higher base understanding of entrepreneurship, of building technology products, who know what good looks like, so they can take that experience forward to contribute in the long run. And I think we always try and anchor to this sort of transition period we see in different ecosystems. I'm sure you see it here. We certainly see it in Europe. We see it, in all markets, benchmark versus the US. And we sort of encourage that, nurture it, but do it in an environment where laws of gravity apply.
Yeah, I mean, I can definitely see the argument actually from, I was a founder before I got into venture, and if somebody is willing to give you money at a high valuation, it is really difficult as a founder to say no, especially if it is your first rodeo and you don't necessarily understand the implications of what the later rounds are going to mean for you when you raise initially at too high of a valuation. Now, on the fund manager side of the world, I think there is certainly some trends that were concerning. Public markets were pretty much completely divorced from private markets, or actually the vice versa. And I think you also had big players coming in and acting like seed players, writing checks at crazy valuations, really at too high of a frequency, and we've seen that pull back. But if your model is, we have a a kind of widespread model. We have done a deal a day for a decade, and we'll continue to do that. But our model is coming in at a very disciplined valuation, and so we, weren't able necessarily to play in that excess, but it works for us based on our portfolio construction. So I don't know if there's necessarily a fault, but I think there's certainly an awareness that's now been generated. But at the end of the day, I think, again, it's just, founders need to keep starting companies, keep raising money, and as much as they can, kind of ignore the hype of what's going on in the market.
Ahmed, you're a veteran. You've been here for, 25 years? Like, you're a veteran in the industry, so...
I'll tell you what I saw in 2001 when we actually started investing. That's how long it's been. And we actually got to with the bubble burst, and back then, we actually had to sell all our champions today, Otlub, Mosrawi, and a few others to another company because our manager, our fund, and our CEOs didn't really believe that we should continue investing in the .com and the tech. It was a bit early back then for Egypt and for the region as in general. But I will also add to what's all been said here. Again, as a founder, lessons learned. You have to be responsible for yourself and for the LPs. Don't get the hype. It's so hard to say this, but I'm just going to say it anyway. Don't go for the hype. Go for what you believe. Go for your fundamentals. At the end of the day, it's still your company. Whether VCs helped you create it or helped or misled you, if you fall, it's your fault. You think about it wisely. Your company, your name. So you take it how you really believe it should be. And so that's the end of the thing. There's nothing to say more than that. Just remember always cash flow, cash flow, cash flow. Without cash flow, this thing is not going a lot of places.
Cool. So, thank you. So, at RaliCap we have 65 portfolio companies, and I spent most of the year just firefighting, helping them survive this upcoming period. And, I'm really curious about how VCs actually help portfolio companies restructure and go through this hard time. And please, let's avoid the, decrease cost and, aim for profitability, because, that's the generic Twitter advice. But I really want to have real examples. You don't have to name the company, keep it anonymous, but really, how can a VC help a portfolio company during these tough times?
Yeah, I'll add one point and let you all cover the rest, but I feel like there's a founder therapy, lots of founder therapy going on right now. You got to pick up the phone. It's really lonely as a founder. It's even more lonely when the business isn't going well. It doesn't mean you can't get through it, but I think as VCs, one of the things we can do is just help to provide perspective from the business perspective, from where they are in their life, the fact that life will go on, they will get through, the downturn. I actually think it's a really valuable part of our jobs. And right now, especially, we have to really be there to support people through this time.
Fully agree. I think founders need a friend, especially in tough times. What I'd add to that is, earlier this year, and I'll talk about what the approach we took. So earlier this year, the environment changed, and I think investors are quite plugged into what is happening in the fundraising ecosystem. So I think the onus almost fell on investors to relay these messages to the founders. And we went through an exercise, almost a portfolio health check with our companies, where we looked at how much runway each business had. Is the business model built the way we think it should be for the coming 12, 18, 24 months, based on the new lay of the land as we saw it? And does each business have sufficient cash and liquidity to take it to the milestones that it needs to have, i.e. the proof points they need to showcase to the next incoming investor for their next round? And in situations where the answer was no, there isn't enough cash, you had to kind of lift the hood and some difficult decisions had to be made. So that's things like, is your cost structure fit for purpose? In a period where capital was cheap and abundant, the answer is almost grow, higher. Instead of testing one or two things, test 5 or 6. Capital is readily available, the building blocks are cheap. That environment changed. So have you overhired? Have you spread yourself too thin and gone into multiple business lines? Do you need to retreat and focus on a core business that you're very good at? Do you need to focus on or trim down some of the excess hiring that you've done in the last couple of years? And finally, and this is, I think, most prevalent for early stage companies, coming back to this learning agenda point, as an early stage company, you are learning. You have a set of cards, and I think previously a lot of people were just playing all the cards at the same time because they could afford to. But now you have to be very objective and intentional with what you want to test first, and you will have to make trade-offs. So going through that exercise was tough, and founders, it's at the end of the day, it's a founder's baby, right? There's an emotional attachment. I've got 4 products which I'm equally in love with, but no, actually, I think you can only afford to work on prioritize 2, and the other 2 you can kind of live to fight another day. So some difficult decisions and discussions had to be made. But if you're solving and optimizing for a sustainable business that will stand the test of time and prevail, difficult decisions sometimes have to be made.
And sorry, George and Ahmed, do you have a specific anecdote you can share about the company you really helped?
Yeah, I mean, we actually published a bunch of the stuff we did online. So if you Google Sequoia adapting to endure, you'll see 4 sets of materials focused on 4 very specific execution points. Yes, explaining the macro, but like you understand you need to reduce costs, you understand that might have implications on headcount. How do you actually go and facilitate that and communicate that to your team? So I would check it out if you haven't already. But yeah, I mean, some specific examples, like companies do have opportunities to come out of this hardship better if they make very smart strategic decisions. And if you look at a company like Airbnb that went into COVID, obviously they have a huge, like primarily cross-border travel business, looking at the abilities to lean into some of the trends and nuances that come out of this macro backdrop that is not related to fundraising, not related to things inside the building, but actually relating to your customers and how your customers interact with your business and use the product. They've basically been able to revolutionize the way they serve their customers and focus much more on longer term domestic stays, which is actually much more favorable in an environment where people have less money to go on expensive holidays across the globe. I think it's a good example of how you can reach out to your community, all these different stakeholders, and really do great work. Yeah.
Okay. Everything here has been said is definitely the right prescription. I'm just going to add a couple of things. For me, I'd also add, if you're going to fundraise, then you have to have some cash. So if you don't have cash, the VCs are going to tear you apart. They're going to take you with very little leverage. You're going down with a bad round. Having said this, so you have to think of keeping cash before you fundraise, and you have to think of the flexibility you're going to have to play in a market that is very difficult. So the market is now VC market. They actually play with the valuations. So you have to be much more responsive. They call it a VC market, favored market. So you'd want to. We had some examples actually the last couple of years where we had to consider swaps. Maybe you swap into a better company, a bigger company, but obviously you try to maximize that negotiation rounds. Be flexible. Don't turn off rounds that may not be very attractive. You might, if you want to survive, and there will be a day where you come back again. So take the opportunity and do not actually throw it away out of emotional frustration. There's nothing more to say.
Awesome. I'm being told we're at time, and we only have the time for one question. Green shirt, we already had you before. A white shirt. Sorry, too late.
Oh.
Sir, if you can please give us your name and what you do.
Thank you. I'm a student. My name is Hamza Ismail Solman. I'm a student of Heritage. I would like to ask a question. What can VCs learn from the disaster that is FTX?
It's a great question. I mean, I think when you think about the business that we're in, obviously we're taking risks, investing in people and ideas that we think will change the future, hopefully for the better. Naturally, as part of those risks, they manifest in a bunch of different ways, sometimes unexpectedly. I think a lot of the learnings from something like that are obviously still coming out, and I'm sure will be discussed in public over the course of the next few months. But I think a lot of it is about actually just going back to basics and doing the right thing and running a business with oversight and controls and treating customers fairly, frankly.
Nothing to add, really. I think empirical evidence will show that probably 8 or 9 out of 10 startups will fail. So it's not unusual, but I think failing for the right reasons because you're learning as opposed to there's kind of dodgy stuff happening is I think what the type of failing that we should be embracing. I reiterate, we're in a very risky business. It's called venture. You're venturing out behind a founder, behind an idea. Won't always work out. I think that's just the way it is.
Kyane, do you want to take 1 or 2 more questions? Yeah? Okay, so we've got a gentleman here, if that's okay. All right.
Thank you very much. Mohammed Ali, I'm a principal at Global Ventures. And I have a question for international investors on board. I just said my name. Okay, Mohammed Aladdin. I'm a principal at Global Ventures. Thank you. So my question for international investors is, in a time of a slowdown, usually we tend to see that international investors would fall back to their home market at one point. And when we look at the region, there was some sort of challenges, particularly on the late stage side of funding, that might actually come to a bit of a crunch over the coming period. So maybe from the early stage and late stage perspective, how this would affect your deployment strategy on an early stage part, and how a late stage investor would look at this for deployment strategy and structure as well.
Sure. So from our perspective, again, 500 is both global and hyper-local in the sense that we're creating regional funds and regional teams, et cetera. So in the Middle East alone, we will deploy 50 to 60 new investments in 2023. So no slowdown from our perspective.
We have a global footprint at Sequoia in that we have 3 fund families across the globe: our US Europe business, our India Southeast Asia business, and our China business. And actually, a bunch of our colleagues from our India business relocated to the UAE during COVID, initially temporarily, now for the long term, with a view obviously to being much more active across the Middle East and Africa more generally. We're actually delighted that we made our first investment in Egypt, specifically earlier this year, a company called Telda that I work with. We made a couple more in Africa as well. And I think we recognize again that the problem we're trying to solve is the same. We want to be in business with incredible founders building these generational companies. They will come through economic cycles. We need to lean into that to make sure that we're supporting it.
By the way, this discussion has really generated a lot of interest, and I don't want to move on until we give people the chance. But can we just please try to make the questions very straight, quick, and can we get one answer from one guest? Just because I want to share the time with everybody, yeah?
Can I just add something? Somebody was asking, what would you do as a fund manager? One of the things I would actually add to what was said is that we have, you as a fund manager, you want to have a follow-on strategy where you actually invest in the companies, and once you've actually invested in, there is a follow-on part where you can actually invest in the ones that you feel that are actually deserving for the next follow-up. So that's always very important to also to have as a policy as a fund manager.
Yeah, thank you. Very insightful discussion, I must say. Thank you very much. My name is Yusuf Howard from Legal Circle. We support startups from a legal perspective, obviously through the fundraising process. And part of our model is really educating the startup from, what to expect when negotiating with VCs, etc. But it would be good to know from a very high level perspective, what advice would you give to startups to best position for VCs? So in terms of their pitches and what information, like you were talking about, cash flows being very important. But what other aspects do you guys look for in founders when pitching to VCs?
I maybe call out one thing that is important. We talk a lot about this idea of having a unique and compelling insight. Unique obviously implies different, which generally implies gross margin in the long run. Compelling obviously implies better. And an observation we have is we obviously receive millions of pitches. Many of them focus on, I guess, how compelling it is, and they talk about kind of high-level market trends, things that are objectively true, but sort of generically true about the given space that they're solving in. And a lot of that uniqueness is sometimes lost or kind of underrated. And I would really emphasize that. Like, you need to be unique. You need to look at the existing NPS of how this problem is solved today, the NPS of your solution, and expect it to be radically better. Because if it's not radically better, you're never going to create the space and the gap you need to create an enduring company.
Okay. And in terms of the qualitative versus quantitative aspects in pitches, for example, is it good to sort of have a balance between the both? You obviously look at qualitative as part of that, but in terms of positioning as a founder, what do you see as being beneficial? Are they equally as beneficial?
I think we just value insights. I think we can do the work to look at the TAM and read the McKinsey report. We don't need somebody to do that for us. But what we do care about is the insight you have into the market structure, how you'll attack it, where your uniqueness comes from.
Hello, everyone. My name is Olicia. I'm representative of a small business in Egypt. I'm a foreigner who lived for 18 years and did some small project. And I have a question to Mr. Ahmed, I think. In case if my business is running by me as one-man show and then I little bit grow stagily and I survive in all economical issues and so, in which stage you can advise me if I feel that my idea is kind of unique and I have perspectives and I have to potentiality to grow well in Egypt on a scale of country, in which moment I can decide to ask for investment to raise it up to the national power?
I'm not sure what the... usually we start from early on as pre-seed transactions. There are a few exceptions where we might make fund an idea from scratch. We invest, our transactions are usually from $250K to $2 million. We usually like to invest earlier on and then follow on with further investments. So that's just to give us a flavor of how things go. I'm not sure your question, I'm not sure what your question is.
I can re-ask my question. How usually, guys, it's going on really in practice? Are you looking for those who want to look for investors, or we have to apply to you to ask for investing?
You have to apply to us because we will probably not have heard of you in general.
Yeah.
So usually you have to apply to us. How do you do that? First of all, is a website. That's number one. And second, usually if you go through the social networks, you'll be able to contact us. There are several ways you can actually reach us online.
Okay, so my question was first one that, in a point of advice, in which moment I can ask for investor when I feel like, it's a time.
For us, we would like to see an idea that has started a few months early with attraction, and you can see the growth growing from month over month. We like to see that there is a good understanding of where the product is generally going to go, because usually early on it might be some testing, and so we're looking for product market fit. That's our stage. We'd be looking for something usually around, you come to us with an idea, it's been growing for say مثلا 6 to 9 months or to 10, so it's that range. We want to see some sort of a trend. We want to understand where you obviously will go first to your friends and family, social angel investors. You can pick up money from, that's actually very healthy in Egypt, and if you find the social angel networks. And then sometimes if you want to start early on, you also go to accelerators. And so there are several accelerators. We in Egypt Ventures, we've invested in Flat 6 Labs. We actually own Falak. So these are two accelerators. We also, so you can go to accelerators early on, so where we don't actually go, and they will take things from businesses or opportunities from day zero, we will take them from 6 to 9 month stage. So I don't know if I've answered you.
All right, we've got time for one more question here. Are you good over there? That's it? Yeah?
Yeah,
Okay.
I answered.
Okay, all right. Last two, one here and one there.
Hi, my name is Michael Gord. I'm the founder of an ecosystem focused across the blockchain, digital asset, and metaverse capital market, super focused on disruptive technologies. I'd love to know what disruptive technologies you all are most focused on with your investment thesis.
We're agnostic in the sense of our early stage vehicles are investing across all sorts of segments, so not a single focus for us.
So crypto is about 10 to 15% of our net new investments, to give you a sense of mix, but we invest as generalists. I think other things that they're calling out at the moment, there's huge emphasis on automation, as manufacturing generally moves back within borders. Computer vision, we're seeing a lot, and we're always excited about new trends in consumer social that we're seeing emerge.
So at A15, we're sector agnostic. We're an early stage fund. We invest anywhere up to and including Series A. From a blockchain perspective, we have a portfolio company that builds or offers as a service the creation of utility tokens developed on a private Ethereum blockchain. So it's, I think, from a blockchain and Web3 perspective, it's still relatively nascent in our part of the world, but I think it's quite an exciting one, notwithstanding the kind of what's been happening that's been well covered by the media.
We're also sector agnostic, so we're open for any idea that comes along if it's got the right sauce, pedigree, and feel and touch. We're in for it.
Please go for it.
Thank you. My name is Tariq Khater. I work in investment banking. I have a question here actually on the lessons learned to the VC investors in general about the implications of the change of the basis of valuations and going back to basics and fundamentals. How does that actually affecting your target returns, your investment horizon? Because in fact, what was happening before, VC investors were incentivized to have subsequent valuations happening at higher pace, with higher valuations, more frequent ones, because they actually do like more unrealized gains and returns, and that actually like supports the whole ecosystem. But now with the change in the basis and fundamentals, you'll actually be building the company at a longer time frame, and that implies that subsequent valuations will be lower, returns will be actually probably lower. The mix of aggressive growth and profitability probably won't happen only for exceptional companies, but the norm would be slower pace, slower growth with profitability. Are you ready actually for lower returns and longer investment horizons?
So we can only focus on things inside the building, if you like, that are inside our control. At Sequoia, we actually restructured our whole business around basically that insight. So we basically are now, as of the end of last year, an evergreen fund. We don't need to raise net new capital from LPs. It means that we can hold shares in these companies well beyond the lifetimes of a regular fund. If that's 50 years, that's a wonderful thing, because that means that that company has succeeded over that time frame, compounded for that number of decades. I think that's important because you build this relationship with your LPs as well, right? Remembering it's not our money, we're investing in these companies. You need to build that sense of understanding that it takes that long, it might take longer to build a scale of business that will excite us, but it doesn't impact return thresholds, any of those things, because it's all what you can control.
So I think it's an interesting question, and I think you're supposed to be on this panel, so you're a double agent. So what business is a venture capital fund in? You raise money from limited partners, and your promise to them is, I want to maximize dollars returned in your pocket down the line. That does not mean mark-to-market unrealized gains, i.e. paper gains. No one really, people used to care about that. I think people care a lot less about that now. They care about dollars in their pocket. With that being said, I think any new investment that a venture fund is making now, or actually even before the kind of the market downturn, you need to underwrite a case where you're achieving your target return. If you're a fund that sees yourself exiting a business in 5, 7, 10 years' time, what do you expect the business to look like at that point in time? At what value do you expect to exit it? You can look at kind of long-term average multiples, take a bit of a haircut to be conservative, and work back to see how much you should be willing to pay today based on a forecast that you have high conviction on and an exit forecast that you believe is conservative, And that should dictate what you should be willing to pay today. And I think people are starting to become a lot more disciplined with that sort of approach now than things were over the last few years. And it's tricky, right? If you're investing pre-seed and seed, it's probably more art than science, right? There's very little to analyze, there's very little to build conviction on. So you have to be disciplined with very little information at hand. So it's not easy, but I think there's more discipline, to say the least, at the moment.
All right.
Can I just add to this? For us, at the end of the day, it's not one company. Now, the problem is if it's actually hitting everything, that's something else. But in general, you will have losses, so that's possible. There's no problem. But you also have to think, what do we promise our LPs, our shareholders? We promise them a certain return. We don't promise them all the wonderful numbers like 10 times. We don't promise that. IRR is usually anywhere between 20 to 30, generally speaking. But so if you have some winners and you have some losers, at the end of the day, it's your portfolio. This is a question that fits every investor with his own position. So to answer you would be saying exactly what we have. But in general, it's about the average. It's not about a company or two. And also you referred to the unrealized. At the end of the day, the unrealized is a benchmark. It's not the final exit. Exit is where you actually are being tested, or you're being recorded. But the rest is, again, unrealized today may change and be a different number in a few months' time. So that's also very subjective. It's very also in the air, if you like. It is just at this point in time when your fund manager promises you a certain unrealized gain, it is at that point in time, not the day after and not the day before. So they do change. I don't know if I've...
Well, that was informative, to say the least, and fun. Thank you, panelists, for the genuine chat. And let's get back to work.
One moment, sorry. I can't say no. The editor-in-chief of Forbes is saying one more question. Yes, ma'am, here you go.
Thank you. Hello. I'm going to just ask a quick question. What is the threshold for a fund for failure? Like, is there a threshold that you, or a percentage of fund that you say, okay, I'm going to write this off?
At the point you invest in every company, you do it because you have incredible conviction in what they're doing, to state the obvious. I think the output of that is, you see the aggregate numbers of whatever it is, 90% plus of startups fail in some shape or form. We know that. I think implicitly what you see in early stage funds is it might be in the range of 30 to 40% of the ultimate, portfolio goes to some level of write-downs. But again, each individual decision is being made with that level of conviction.
When the company goes bust, this is when we actually write it off. Until then, there's still a little bit of hope. It depends on what your internal policy is. Every fund manager has a certain internal policy, so it ranges from one to the other. Yeah. And also from stages, early stages have a different treatment compared to larger stages.
Thank you. Clearly, there's a lot of questions that the audience has for you guys. So I just want to remind the audience that if you didn't get the chance to ask now, you will be able to talk to them a little bit later on. I'm sure there's going to be a lot more. For example, how many people have questions? Anybody else have questions? No? Okay, so there's still a few, right? You can always talk to them afterwards. We're going to take one last one right here, and then we'll move on to the next section.
Hi guys, my name is Hadia Ghalib. I have a marketing company called Ghalib Production House, and I'm one of the 30 under 30 listers, alhamdulillah. Recently I started a brand only 4 months old, and we've had huge success. We sold out completely. And I'm now in a debate with my father, because we work together. We're in a debate if in the next, because we need to buy more products to sell. I'm telling him I don't want any investors. I want to put all my money, all my savings. I don't want anyone to take a single percentage of the company because I have a lot of faith. He's telling me, no, you worked a lot and you worked so hard and you saved all this money. You shouldn't put it. You should find an investor. Do you advise me to put my money and not have anyone on my back telling me what to do? Or you think it's a safer idea to take money from you guys?
This is not financial advice.
Yeah. Well, first of all, I follow you on Instagram and I love your brand and what you've done. So I was really excited to actually see you come in the door. So you should all check out Hadia's brand. So really cool to see you. But yeah, I think you really need to, just think about what you want. Like venture investors like us, we're looking for multiples that are hundreds or sometimes thousands, or like our ideal multiples when we make an investment in a company. So for a fashion brand and retail, I think you really need to look at what's expected when you're raising, capital into that specific vertical. But I don't know, I don't have advice for your father or for you specifically, but I think what you're doing seems to be really taking on a life of its own. So that's encouraging, and just wanted to say congratulations.
I just want to say that hopefully not everyone thinks that way, because if everyone decides to invest their money and not come to speak to us, I think we'd be out of business. So, but jokes aside, it's important to bear in mind that venture firms and venture investors bring more than just capital. A lot of us have been doing this for many years, have seen things go through different cycles, businesses across multiple sectors, different stages of evolution, and there's the benefit of learning from that. So I think as you make that decision, and I can't make that decision for you, I don't think anyone can, you need to decide what you want to do with your money, but you need to think about what skills you feel you could benefit from as a founder, as a business, and try and look for those skills in the investors that you're speaking with. And these investors don't need to be venture funds. They could be family members, they could be friends, they could be anyone, but it should be someone that adds value to your business, either strategic, someone could just be a friend that you can come to with kind of hardships, not just money. I think the money helps. That's we're in the business of investing money and making money, but at least we like to think that we bring more to the table than just money.
There's nothing. Yeah, I'm only going to add that: do you want to stay with your company as is forever? Then don't go to anybody. But if you really want to put down more discipline and corporate structure, and sometimes that's very valuable and important if you want to corporatize your business, meaning you want to have eventually other team members joining you and becoming part of your organization. You want to hire talent from somewhere else, but it depends on your stage, of course. You want to attract talent. You want to, and they become, they might even be equals. So at some point in time, this will happen. If you want to attract talent, you want to grow the business, you will want to have an investor on the side putting what is corporate, help supporting you in what is corporate procedures or understandings. You will want that at a later stage when you're re-expanding. Maybe today it's possibly a bit early.